Good morning, everyone. Happy August 4th. It's August 4th, so we're right in the middle of the third quarter of the year, and we're here to bring you the market updates from Clark Capital and Glenn Dorsey. Today we're going to go through about 15 to 20 minutes of commentary about markets, what's happened and what's on the horizon. And then we'll leave it open for some Q&A after. Again, thank you for joining. If you're not here and now you're receiving it via email, this has all happened in the past, but you'll get this video and we'll send this video out to everyone. And thank you for joining again. And I'm going to kick it over to Glenn.
Great. Thank you, Adam. Good morning, everybody. Happy Monday, everybody's favorite day of the week. As you can see, I am in always sunny Philadelphia and getting a tan as we speak. Before I dive into taking a look at some of the gauges, I figure I'd tackle the tariff in the room. There's been no shortage of tariff news over the last several months, and we had the April 2nd board that came out, which spooked the markets, and we had a very quick, almost 11% sell-off in the S&P over 2 days, which is pretty significant. And then we had April 9th, where we postponed the tariffs until July 9th, and then we had a up 9.5% one-day S&P move, which is one of the top moves on a daily basis ever. And I think it goes to one of those you probably may have seen the studies where if you miss the top 10 days over time, your return in the market is significantly different, and that would certainly be an illustration of it. I think what this year's market has done, it really stresses the time in the market, not timing the market, and also speaks to staying focused on your long-term goals and objectives. I find that the less frequently people look at their accounts, the happier they are. And this year's a great example. So if you went to sleep at the end of last year and you woke up on June 30th, you'd see the S&P was up about 6%, bonds are up a few percent, and it would look like a good but relatively boring year. The same is true if you checked it just every quarter. If you looked at the March 31, where the markets were, things were pretty good. And it was really in April that things fell apart. So it's those of you, and I know some of you are guilty of it, that check your account balances every day, that saw your blood pressure go up and your anxiety go up. And as we've seen, the market recovered as it usually does. And why? Is because record earnings are being reported by the S&P 500 companies. Right? At the simplest form, and it's easy for anybody to understand, if a company makes more money over time, it will be worth more. And companies that make less money over time will make less or be worth less. Not worthless, but worth less, right? And that's what we focus on. So what happened is when companies reported the first quarter earnings, the first quarter was pretty good, actually. It was another record high, but a lot of companies told the analysts, that Wall Street analysts that follow them and try to estimate their earnings, they said, you better lower what you think we're going to make because the tariffs. And what we've seen is that the tariffs have had really almost no impact on earnings so far, right? And as a result, the second quarter, we're right in the middle of the second quarter earnings reporting season, is companies are beating the analysts' estimates by a pretty wide margin. About 80% roughly of the companies reporting are exceeding analyst estimates. And now all the analysts are raising their companies are expected to make for the full year and for next year. So we're at a point now where earnings estimates are actually going up. And if you follow the premise of, when companies make more money, they should be worth more, we're in a good overall fundamental backdrop. Our companies are making more money. The profit margins are solid. And that's all good stuff. Around that is all of the news, right? And which I call noise. Most of it's noise. Every day we get this is going to happen or that's going to happen. So one of the things that I think is interesting is that people talk about tariffs as being inflationary, and historically they're really not. What you really have to think of tariffs are as really a tax on companies right? Because the companies that import goods are the ones that pay the tariff. Now, what generally happens is the exporter takes a little bit of the tariff. They'll absorb some of that in lower prices. The importer will absorb some of it, and some of it does get passed on to consumers. So the immediate thought is, well, okay, well, inflation has to go up dramatically. And that's not really fair. So if you look at overall, the US imports $2.7 trillion worth of goods. If tariffs went up by 15%, that's about 400 billion, right? And when you start to put it in the context of a $30 trillion economy, you get a sense that it's not quite as catastrophic as some people suggest. That's about 1.3% of GDP. The reality is that the inflation will not go up by that much. And the reason is very straightforward is we're good consumers. So what happens is if something goes up a lot in price, we generally do one of two things. We'll buy something else that didn't go up as much in price, or we just might postpone buying it. That happens a lot of times. If you see car prices go up a lot, then you'll see the average age of the cars on the road go up. People will just hold on to their car longer. Adam, you've got a 1972 Ford Maverick, I think you're driving now. So, you've postponed it, right? And that's what people do. We saw it with egg prices. Egg prices went from 3 to 12 and back down. People stopped buying eggs. And ultimately, supply and demand is going to determine the prices. So, and we saw this in President Trump's first term in the summer of Chevy Vega. Nice. We saw this in President Trump's first term in the summer of 2018. We got into this tariff war with China. Everybody said we were going to go into recession. We were going to have inflation, all of that stuff, and none of it happened. Right? So from the summer of 2018 to the right before COVID hit, and that threw all the dynamics off dramatically, CPI, the Consumer Price Index, measure of inflation, actually went down over that period of time. And the S&P 500 was up almost 25% over that same time period. So we've shown that the companies are very resilient, consumers are very resilient, and I don't expect it to be much different than that. Can the global economy and the U.S. economy live if we have a 15% type tariff on some of our major trading partners? Yes. And the reality is the numbers I gave you with the 15% across the board on all goods, that's not going to happen, because a lot of the goods that come in from Mexico and Canada are still covered under the U.S. Mexico-Canada agreement. They're not subject to whatever tariff rates that we're talking about putting on Mexico and Canada. China is the big holdout right now. At this point, the most important one. We have a framework of a deal with the EU. We have a framework of a deal with Japan. A lot of details to be worked out. But what I think this really does emphasize is how important it is to be selective in what you own, right? There are time periods where, well, I just want to own the market because the market is going up. Well, the S&P 500 is pretty concentrated now. About 7 companies represent about 30% or so of the S&P 500. So it's very, very concentrated benchmark. And they're good companies, but in our belief, when you're trying to control risk, you really need to be more diversified than that. And the other point, I think, is that wherever the tariffs end up, there will be winners and losers. If you are actively managing the portfolio, you can be more selective and try to avoid those companies that are going to be hurt, and emphasize those companies that are going to actually benefit from tariffs. And there will. That's how it will play out. There will be winners and losers. And as an active manager and being selective, we want to focus on high quality companies. We want to make sure that we're adequately diversified so that we don't have too much risk in any one company. That's, in our opinion, how you stay rich. That's our number one goal, as Harry Clark always says, is we're in the stay rich business, not the get rich business. So you want to focus on quality and diversification, and that's what we do. So I'll run through a couple of, I'll just show our gauges and maybe show a slide or two uh, to highlight some of our points. Hopefully I'm sharing, looks like up now. All right, perfect. So going back to the original premise that earnings drive the value of companies. And then the other aspect of the value of a company is what are people willing to pay for those earnings. So these 5 gauges capture one or both of those. And if it's straight up and down or at 12 o'clock, it's neutral. If it's to the right, it's good. To the left, it's bad. The economy has been pretty solid. We had the first quarter GDP, well, actually, it was negative. It was minus 0.5. And the reason was pretty straightforward is that companies raced to get ahead of the tariffs, and there was a huge spike in imports. The D in GDP is domestic. So imports are actually a subtraction from that, which is why we had a negative first quarter. And we saw the second quarter, which came in at up 3%, which is a pretty good number, saw the opposite. We saw imports actually go down as a result of some of the tariffs and companies working off the inventory of the goods that they had stockpiled before the tariffs were supposed to kick in April. Ultimately, the U.S. economy is driven by us, the consumer, and we are more remarkably resilient. The labor market is really important. Now, on Friday, we had the non-farm payroll number comes out, right? So how many new jobs are created? And we had, I think it was 73,000 new jobs, which is pretty good. Unemployment ticked up a little bit to 4.2% from 4.1%, but that's still a pretty low number. What got the market a little chaotic on Friday is they revised the prior months that came out, May and June, they lowered the number of new jobs by 258,000 over those 2 months. That's a pretty big revision. So over the last 3 months, we've had fairly low new job creation, but importantly, we have not seen a significant uptick in layoffs. Companies are still hoarding employees. They're very reluctant to lay off people. They're also hiring less, which is why we're seeing the new jobs go down. The growth of the new jobs go down a little bit, but unemployment really hasn't moved up either. And that's fine. As long as we have jobs, the average work week went up, the average pay per hour went up. As long as U.S. consumers have jobs, they're buying things, right? That's really the environment that we see right now. I heard a great expression that I like. It's like when American consumers are happy, they shop, and when they're depressed, they shop even more. And we've seen that. When we saw consumer sentiment numbers dropped way down, everybody was so pessimistic, but it didn't get reflected in sales. We continued to shop. So we'll keep an eye on the labor market, see how that plays out. We think it's going to be that type of an environment where it's slow hiring, but not a significant pickup in layoffs. We've seen inflation continue to trend down. It's still not to the 2% level that the Federal Reserve wants to see. And that doesn't mean that prices are going down. What it means is prices are going up less rapidly, right? So, where everybody's still talking about inflation, but inflation peaked in June of 2022, a little over 3 years ago, and has been slowly but surely making its way down. And we continue to expect more progress on that. You might get some blips up now, in the next couple of months with some of the tariff things filtering through, but it should be relatively minor. Monetary policy is the Federal Reserve. And again, going back to the economy, like we really focus a lot on the jobs market because that's going to affect the consumers. And the other thing that we really focus on is earnings. So right now for 2025, our full year earnings are expected to be up almost 10% from last year. And for next year, the estimates are for growth of over 16%. Now that's probably overly optimistic, But nonetheless, if our companies are making more money, that's a pretty solid underpinning for stock prices. The big bear markets that we've experienced, where stocks were down 20% or more, have always been accompanied by a collapse in earnings, and we're not seeing that, and we don't see any evidence that that's about to happen. That doesn't mean we don't have our normal volatility along the way. Healthy pullbacks happen on a pretty regular basis in the market. 5% pullbacks happen about 3 times a year, just in an average year, right? So, we should continue to expect that to happen. What's important is not to hit the panic button when it comes along, because it's pretty normal. Monetary policies, the Federal Reserve. And so the Federal Reserve has only 2 things that they're responsible for by act of Congress, no matter what you hear and what anybody wants them to do. One is full employment, and arguably at 4.2% unemployment, which is pretty low, we're there. That looks pretty solid. So the Federal Reserve doesn't really need to do anything on that front. And the other is inflation. Now they're targeting 2%. We're a little above that, which is why the Federal Reserve hasn't done anything so far this year. So why do we have this in positive territory? Well, they did lower the federal funds rate last year from 5.25% to 4.25% at the end of the year. A full percent came off, and the bias is likely for them to cut more this year. We can look at something called the Fed Funds Futures Market. And after Friday's revisions to the number of new jobs, we saw expectations jump up to 3 cuts by the end of this year. And many suggested that if Chairman Powell had known that those revisions were going to happen, we might have even seen a cut in July. Right, so we expect the Federal Reserve to slowly lower rates. They don't need to rush because, again, the economy is still doing pretty well. But I think what you'll start to see is just an easing, easily pushing on the gas pedal to make sure that the labor market doesn't fall apart too quickly. Why does that matter? Stocks typically do better when the Federal Reserve is lowering rates, right? It's a boost to the economy. It's a boost to earnings, and it also the multiple people will pay for earnings typically goes up when the Federal Reserve is cutting rates. Why do we not want to see the Federal Reserve cut rates quickly? Because if they're cutting rates quickly, it's because the economy is falling apart. It's not a good sign, right? So people that are hoping for a lot of cuts are missing the point of what the Fed's trying to do, and that's that balancing act of controlling unemployment and inflation. So valuations, we did move this back into slight negative territory. And don't hit the panic button over that either. Historically, valuations are not a terribly good timing tool. Stocks can be trade at kind of high levels. And when we're talking about valuation, it's just like if you were going to buy a business, before you bought the business, you'd want to know what it's earning. That's the E in the PE ratio, and the P is the price. And so just like you would, this is how we look at companies' valuations and a lot of different metrics as well. So when you look at the overall S&P 500, it's about 22 times earnings, which is at the high end of historical range, not totally out of line, but at the high end. Part of that, however, is because the Magnificent Seven companies, which make up 30% of the S&P, are trading at about 29. Right? Why do they trade at a higher multiple? Because they are more profitable and earnings are growing faster, right? So people are willing to pay a little bit more for that. When you take out the Magnificent Seven from the S&P 500, that leaves you with what we call the S&P 493, right? And that's trading at a more reasonable, though not cheap, 19 times earnings. And if you just look at the average company in the S&P 500, take all 500 companies and look at where they're trading, it's about 16 times. So this goes back to my original point of selectivity, right? There are still some stocks that are pretty attractively valued, and there's still some stocks, while not necessarily cheap, have a very good profitability and earnings growth characteristics. So you want to own probably some of all of these, and this is how you become diversified. If you're overly concentrated in just these, you're going to have a very bumpy, turbulent ride along the way. So you want to own them, but probably not in the same weight as the S&P 500 to stay diversified. So again, it's we have it as a modest negative, nothing to be alarmed about. Investor sentiment is a more fun gauge. It's actually really good at finding bottoms in the market, and it's based on the expression Warren Buffett had: is you want to be greedy when people are fearful, and fearful when people are greedy. And what does that mean? So when you feel great about your portfolio and the markets and everybody loves it, we're going to be negative. When people are scared, and that always happens right after the market went down, this is where we were in April, we were full positive because fear levels went through the roof, right? So expectations at that point are so low for the market, it really doesn't take much for the market to exceed the expectations. You don't need great news when expectations are very low. You just need not horrible news, and then the market can go up. So when we saw the tariffs postponed on April 9th out to July 9th and then ultimately August 1st, that's not great news, but it wasn't the news that was delivered on April the 2nd. So there was a bit of a relief rally that those tariffs weren't going to go into place as they were on the board. And that's exactly what we've seen happen. Lots of negotiations coming, and the ultimate deals that are being struck are lower than what was portrayed on the board. So it's kind of a better news than feared. As the stock market has gone up, this gauge has continued to ratchet to the left, and I will show a little bit more on this. And right now, I'd say arguably today is probably neutral, right? Which given the rally that we've had from the April lows, it's actually quite impressive that it hasn't moved into overly bullish or optimistic territory. That's actually quite encouraging, as a matter of fact. And then lastly, interest rates haven't done a whole heck of a lot of anything. They've done this year. They've been up, they've been down, and they haven't really changed a whole heck of a lot from where we started the year. Some of the 2-year, 5-year, 7-year type bonds, we have seen rates move down, which has helped out the bond portfolios a little bit. So let me go. I'll just pick out a couple of slides. So one thing I do want to point out. Our year-end target for the S&P 500 is 6,700. We never changed that. We said it at the beginning of the year. A lot of different strategists and big firms that you hear lowered their targets when the market went down in April, and now they've raised them back up again. We didn't change anything because we didn't believe that earnings were going to be impacted that much, and they haven't been. So we're comfortable staying there, which still leaves us some room for the market to move up. We are in the period seasonally. The summer tends to be not where the biggest returns for the market come from. That tends to be a little bit flat and choppy in August and September, and even maybe the beginning part of October, and then would typically set up for a fall rally, which is kind of about, wouldn't be surprising if it plays out that way this year. We did lower our GDP forecast for the full year from 2.5% to 1.5%. And that recognizes that the first quarter was negative, right? So that was weaker than expected. We did see a bounce back in the second quarter, but if you put those two together, that only puts us at about 1.2% growth for the 2 quarters. And there could be some modest impact from tariffs going forward. But even at a 1% GDP growth, companies can still deliver solid earnings. When you talk about inflation, right? We feel that, the consumers feel that, but guess what? The companies that we own, they sell their goods with inflated prices, right? With the inflation, they benefit, their revenues will go up from higher prices, right? So if they're able to control their costs and they're bringing in more on the top line sales, they actually could see the profit margins move higher. So this is a little bit about what I was talking about. If you just woke up on June 30th, these are the numbers that you saw for various stock indices. The S&P 500 up 6.2%. Growth and value stocks pretty equal, both up about 6%. Bonds, with the exception of municipal bonds, all pretty solid returns, fairly decent, and they kind of masked the pain that we had during that April sell-off. volatility is normal for the market. So this goes back to actually 1963 is the first year. These bars represent where the market traveled during the year versus where it started. And what you can see, the line I just drew is 0 or unchanged. What you can see is most years, no matter where the market closed, which is these red dashes, at most years the market was down at some point during the year, right? 2023 and 2024, they were unique. We really didn't get tested that much. The market was very rarely in negative territory from where it started, and both years ended up over 20%. This year kind of looks more normal, right? We've got a period of time where we're in negative territory, but we've eked our way out into positive territory, and in fact, we're up about here right now. So this year is more the norm. The last prior 2 years were more the exception. I would love the exceptions. They're wonderful when the market goes straight up without a lot of volatility, but really shouldn't expect that. Again, 5% pullbacks happen about 3 times a year, and you even get a 10% or more correction about once a year. This is average going back into the 1920s, so nearly 100 years worth of market data just shows that volatility is normal and to be expected. So when we talk about unemployment, it's one way to look at the labor market. This comes from, it's called the Job Opening and Labor Turnover Survey Report, or we call it JOLTS, JOLTS. And this is the layoff rate. It's just been flatlining at about 1%. We really have not seen a significant pickup in that. And that's one of the items that we'll keep a very close eye on, because again, people that are working or spending. Inflation, again, peaking June of 2022, more or less moving down at a pretty decent clip. Recent progress is a little bit less compelling. This is important. This is the S&P 500 operating earnings over the 12-month period. And what you can see, again, when I said those nasty markets that we all want to forget ever happened, 2000 to 2002, earnings were down 50% over that time period. Financial crisis, guess what? Earnings were down 100% at the worst part in the quarter. There actually, S&P had an operating loss. Those are markets that we want to avoid. COVID, even we had a 50% decline in earnings. But since that time period, earnings are continuing to hit new highs and are estimated to continue to hit new highs. That's important because as you can see, the blue line is the S&P 500. Stock prices track earnings over time, as they should. This is on a quarter by quarter basis, record high earnings and continuing to be estimated to be record high earnings. In fact, these estimates for 2026 now it's up about here now with the estimates being increased. So that's a really good backdrop. And then I'll show you my favorite. One of the ways, this is AI generated, by the way, ChatGPT. We got Warren Buffett and in front of a board with his famous quote, be fearful when others are greedy and greedy when others are fearful. The American Association of Individual Investors, or AAII, puts out a weekly survey, and they've been doing it since 1987. And they ask non-professional investors if the market will be up or down in the next 6 months. Right? So this purple line tracks the percentage of people in the survey that thought the market was going to go down over the next 6 months. What you will see is that negativity or bearish level peaked right as the market bottomed. Right? And there's a pretty good track record of that happening, where fear levels spike up after the market goes down. And that's generally when you want to buy. You want to buy low and sell high, not the other way around. One of the highest levels ever for this number was back in March of 2009, right when the market bottomed coming out of the financial crisis. So it's a great and useful tool at finding bottoms, because the consistency with how wrong people are about the direction the market's going to go is very useful for those of us that are valuing businesses and not just watching stock prices. If my company is going to make more money and the price of the stock is down, in the real world, we call that a sale, right? If I can buy the same thing or better for less money, that's a sale. And that's really when you really need to stay focused on your long-term goals and objectives and stay committed to buying those high quality companies that are making more money. And interest rates, like I said, haven't done a whole heck of a lot. So this is called the yield curve. So we look at treasuries that mature in 1 month and 2 months and 1 year and all the way out to 30 years. And in red is where we started the year. When you connect those dots, they call that the yield curve. And then blue is where we were back in July. And what you saw is that, treasuries that matured kind of 1 year all the way out to 10 years saw rates go down a little bit, but longer term rates actually went up. This tends to be driven by fears of deficit, which the deficit's likely to go up because of the One Big Beautiful Bill Act, which is now law, right? It's going to create some more deficits, create more economic growth as well. The short end of the curve, the shorter maturities, tends to be tied to federal funds rate, because the federal funds rate is just overnight lending, and Fed hasn't really done much of anything. And this middle part of the curve here is really driven more by inflation expectations, which have been going down. So they're doing what we would expect them to do in this environment. So if I was to sum all of this up, we're going to have more news that scares people. We are going to hopefully continue to see record high earnings. I think that those that are patient and very selective in what they own tend to fare better in these types of environment where there's a lot of volatility. People that get emotional are going to be the ones that get hurt. You get emotional and anxious usually after prices have gone down, and people over time historically have often made very bad decisions after the stock prices have gone down, and they say, I can't take this, get me out. And then they lock in their losses and don't participate in the rebound. So I know hopefully no one on this call ever thinks about doing that, because you have Adam and Jill giving you good guidance on that, but some others do. So I will stop talking and see if any questions came in. Adam or Jill, did you see anything come in? Yeah. All right. So,
Okay, now, yeah, I was muted, so I couldn't help. So a question did come in about the central bank and digital currency, and the articles about digital currency and central bank, and where is that going? And then that can tie even into more the crypto currency conversation happening, and framing around, I guess, two things. Clark is the investment manager, so Clark's going to talk about it from the standpoint of how it impacts the market, bond and stock market. That's the investment standpoint. So take it away from that. I just want to make sure that the question's being framed correctly for where the seat that you're sitting in.
Yeah, certainly the current administration has more of an interest in digital currency than the prior administration. I don't see that impacting the ability of companies to earn more money. So the fact that the government can move huge chunks of money digitally versus a wire transfer seems somewhat irrelevant to how much money companies make. And I would offer that guidance for any news item that you hear. When you hear something, just say, hey, is that going to impact, pick any company you want, is it going to impact XYZ company's ability to make more money? And the answer is almost always no, right? Unless it's something very, very direct. So I think you'll see digital currency continue to grow over time, the use of it. I don't think that makes the dollar useless, right? It's got at all. nor do I see any other country displacing the dollar as the world's currency reserve. And if you think about the very simple reason on that is that in order to be a global currency, you have to have a very big, deep, and liquid sovereign debt market, meaning US Treasury bills and notes and bonds. Guess what? We have more of that than anybody else in the world, and it's way more liquid. The EU, which would be arguably possibly a contender, they have a unified currency, but they don't have a unified bond market. Each of the countries has its own debt. So they're not a contender to displace the US. China has a very illiquid and small bond market, and their currency doesn't even float freely now. So it's not a contender really anytime in the near future to displace the U.S. I don't see. I think there'll be enough skeptics about digital that is certainly not going to knock the dollar out of use. I mean, has anybody ever had a technology problem? You know, would I want all of my money tied up there where if I have a hard drive crash, I suddenly lost all my money? I don't think that's, I don't, I don't see that, but I do see it becoming more widely used. Look how, you know, you use Zelle or Venmo, you know, people are moving money around in ways that they didn't do before, and the wire transfers are probably going to decline in terms of how much they're used. I could see crypto taking a space in that too, but it doesn't, from our vantage point, isn't impacting where we are. Artificial intelligence arguably is a way bigger driver or catalyst for the many of the companies that are out there.
Another question came in, similar topics that are, meaning headline topics that people are talking about. So crypto and digital currency, but this one is about Chairman Powell. And if all of a sudden every replacement is named or he steps down, is that going to have an impact on the on policy and the market?
Yes, it would. His term as chair ends in May 2026. He has, best we can tell by everything he has said, has zero intention of stepping down. I don't think President Trump, for all of his saber rattling, is going to fire him. The market would not like that. Um, One of the Fed governors resigned. So on Friday, so President Trump's going to be able to appoint somebody there, and it's expected that that person may be Powell's replacement in May when his term as chair is up. So we would expect somebody that's a little more likely to lower rates. This President Trump has clearly indicated he wants rates lower, as has every president that's ever been in office, by the way. He just happens to be much more vocal about it. Not surprising. But so I think that we had two people dissent at the July 31st meeting about leaving rates unchanged. They were in favor of cutting rates. They would be contenders for the spot as well. And that's Christopher Wallman and Michelle Bowman were dissenters. So they would be looked upon favorably by Trump. I think it's inevitable that the Federal Reserve is going to be more likely to want to cut rates going forward, as he's able to get more influence by putting another person on the board and ultimately selecting the next chair. So, but that's more likely a 26 event. I think what's very important is that the Federal Reserve, or that the Federal Open Market Committee specifically, remains independent, right? And doesn't look like it is being forced to do anything by the administration. Chair Powell is not going to do something because Trump wants him to. You know, he's in this for his own legacy, and think he did not take this job for the paycheck. Right? Federal government's not known for big paychecks. I'm pretty sure he can make a lot more money on a speaking tour. What he wants to do is preserve his legacy that he saved an economy from a global pandemic without having a major recession, and that he then got rid of the inflation that came about as a result of some of the policies during the pandemic, and brought inflation down and rescued the economy from that. I think he's way more concerned about that than what President Trump says about him.
No other questions are coming in, but interest rates, piggyback on the interest rate discussion with the society, socially, interest rates have been higher than many people are used to over the last 10 years. But historically, they're still relatively low.
Right.
And then the other chart that you brought up was that companies are going to be hitting, and through 2026, projected to have earnings hitting record highs. Where's the argument from an economic standpoint, besides social standpoint, housing market being the area that's been, where's the argument to actually lower interest rates?
I think the argument is that inflation is going to continue to move down. 2% is sort of an arbitrary number anyway. When that 2% number came about was actually at a time period where inflation in the US was below 2%. And Chairman Powell at that point said, we're striving for 2% inflation over the long term. Not knowing a global pandemic was going to come along and see inflation spike up as a result of that. So the reality is that if they had stuck with the language that they had put out before and said 2% over the long term, they could look at 2.5 or 2.7 or wherever we are today, depending upon what measure you look at, and say, yeah, we're a little above our long-term rate of 2%, but if you look at that over the last 20 years, we're okay. Arguably, where the Fed funds rate is now, and Chairman Powell actually characterized it. He said we're mildly restrictive right now. So he's saying, yeah, we're probably higher than we need to be at the moment. And if you look at where the bond market is, you look where inflation is and where the economy is, it does appear that they could cut rates and not have it contribute to inflation. What he's reluctant to do is cut rates and at a time where you might start to see a little bit of an incremental uptick because of the tariffs. And then people are going to say, oh, you lowered rates and now you caused inflation. That's not where he wants his legacy to be. But again, with what the labor market kind of softening, there's more of a bias towards their ability to cut rates now. The economy's been fine. It hasn't needed any stimulus. Which is highly unusual at this point of a cycle. Typically, after a big rate increase like we saw in 2022 and 2023, at this point in time, we're already in a recession and the Fed's already cutting rates, but it hasn't been that way because we never saw the spike in unemployment and therefore consumers didn't stop spending. So they're in a very unusual position right now that they're not really compelled to do anything that quickly. They don't need to.
And then with tariffs, we've had these conversations offline, but tariffs are now in, or apparently in, saying that there's money that's coming in, right? There's revenue coming in from tariffs, but we're really not going to see the economic impact of all this and see the data on it for a good 2 quarters or more.
It's going to take a while. Right. So, what companies hugely stocked up on inventories in January, February, March, they've been working some of those down, and you saw it in some of the GDP numbers. So they were still selling goods that were cheaper than they would be on once the tariffs are fully implemented. August 7th is now when the tariffs kick in officially. So, and will you see it you shouldn't see it on the shelves day one. It's going to take a little while for that to all filter through. Companies that have pricing power will raise prices. Companies that don't won't. Right. And because it's that simple. Let's say the cost of an iPhone doubles. Well, I'm going to have my iPhone 16 for a few years because I'm not going to spend that much money.
Right.
And that's the way we shop. We're pretty smart about things. If something's an absolute necessity, like if all food went up across the board, which it won't, you have to pay it. Okay? You have to eat. But that doesn't happen. That's a matter of fact why they take food and energy out of when they look at inflation, because it's way too volatile. It moves around too much. Yeah, you'll get a big spike up in red meat, and then chicken and fish are cheap, or pork, and people substitute. That's what we do. So I think it's going to be quite a while. It will take, to your point, quarters before this all plays out. And at the same time, they're still going to be negotiating with the other countries that we haven't come to terms with. Right? So it's going to be a long road.
And this is a conversation I've had with a number of clients, knowing we have some manufacturing clients that import their goods from overseas. In November, they had already raised their prices with the
Right.
anticipation of tariffs coming in. So my question there is, do you see the data? Is the data there where companies have already raised prices, waiting for these tariffs to kind of run through?
Some have. Yes, some absolutely have. And others, I saw the interview with the CEO of Amazon where they said they didn't really raise prices because they stockpiled on all kinds of goods before the tariffs kicked in. So they didn't need to have any price increases. And they bought themselves some time to have tariffs negotiated down, which we're seeing happen, right? China's fortunately not at 145% tariff, which was announced at one point, because that would effectively just shut down all trade with China.
Mhm.
So I think, as I said, companies that can pass along the increases do, and those that can't are going to struggle. They're not going to do it.
Well, we are over time today, but and I don't see any other questions coming in. Thank you all for joining us, and thank you for watching. If you're watching this on replay, as we're sending it out to you after, we will have another chat with Glenn in the fourth quarter. I hope everyone's summer is doing well. I know here in New Jersey, where a lot of you are, the temperatures dropped, so it's been a beautiful weekend. I know down in Florida, where Jill is right now, it's pretty hot. So I'm happy that I'm up here in New Jersey with you guys right now. And Glenn's in Philly and in the sunshine and with a great head of hair, as we had that conversation behind the scenes, and we're good. If you guys need anything, please email us. We're happy to jump on a Zoom, meet in person, and looking forward to your comments. Glenn, thank you for your time as always. We love the partnership with Clark, and thank you for your time and your insight. And till the next time, we'll see you then. Take care.
Thank you.